Hey everybody, welcome to Mortgage Today for Tuesday, June 9th, 2024. Oh, today it was UMBS. We're flat on the open, technically up 1 basis point, but whatever. Yields rose microscopically in the overnight session, but even that is a generous assessment considering the range in the 10-year was less than 3 basis points. Domestic hours were off to a sleepy start with yields in an even narrower 1 basis point range. Powell's testimony was this morning, and basically the summaries are: first quarter data did not support greater confidence in inflation path. The Fed needs to cut rates. Easing too little, too late could unduly weaken the economy. GDP growth appears to have moderated in the first half of 2024. Easing too soon, too much could harm inflation progress. The policy rate cut is not appropriate until the Fed gains greater confidence. Inflation is headed sustainably towards 2%. We have made considerable progress towards the 2% inflation goal. Recent monthly readings show modest further progress. Small business optimism improved in June to the second highest reading this year. Main Street remains pessimistic about the economy for the balance of the year. The optimism index stayed in a tight range around 90. Only 8% expect business conditions to improve by year end. Employers created a respectable 206,000 net June jobs, but April and May totals were reduced by a hefty 110,000, and the unemployment rate rose from 4 to 4.1%, the highest level since November of 21. While a July rate cut is unrealistic, the disturbing rise in unemployment rate since 4 of 2023 low of 3.4, along with steadily falling inflation, argues strongly for a September Fed rate cut. From your lips to God's ears, policy is too restrictive. A long-awaited pivot to easier monetary policy would provide investors sitting on a record $6 trillion in money market with an incentive to buy bonds and assets until they see the Fed truly cutting. There is a level of show me, according to Anders Persson, the chief investment officer at Nuveen. There's some skepticism about getting off the cash or money market investments that pay 5%, and many retail investors are sitting on and enjoying. Markets are pricing in Markets are pricing the chance of 2 rate cuts this year, with a roughly 70% chance of the first one in September, according to swaps data compiled by Bloomberg. Bonds showed slightly more notable signs of life this morning when compared to yesterday, but yesterday was all but dead. The volatility surrounded Fed Chair Powell's congressional testimony, but had more to do with what he didn't say as opposed to what he said. Specifically, he didn't express incremental excitement or expectation about economic data justifying a rate cut anytime soon, instead leaving it up to some old data-dependent mantra. Bonds had perhaps been waiting for a bit more dovishness. Even so, trading levels returned to pre-Powell levels by the close of his talk. 10-year treasuries logged a small increase in yield, while MBS improved modestly. Some of that is driven by yield curve, which is shorter maturity. Treasuries improved, and MBS act more like 5s than 10s these days. Either way, the focus is even more firmly on yesterday's CPI as far as Thursday's CPI as far as bond market inspiration is concerned. UMBS closed the day up 6 basis points at 100.67, and at 100.67 it's putting us up there in that range. It bounced up and then came back down today, but hopefully we can make a run at that 100.91 level, because we have all of the technicals kind of converging upon each other right below us as a floor. Also news today, enhancements are coming to the FHA 203K program in November. With the publication of today's notice, FHA has FHA has now enhanced the 203K program guidelines to increase the limited 203K rehabilitation cost from a maximum of $35,000 to a maximum of $75,000. Introduce an annual review process for updating maximum total rehabilitation costs for the limited. Extend the rehabilitation period to 12 months for the standard K, 9 months for the limited. Increase the number of days that a borrower is unable to occupy the subject property during the rehabilitation period from 15 to 30. Permit mortgagees to increase the number of months of financeable mortgage payment reserves for the standard 203K. Allow financing of 203K consulting fees for limited K, and revise the 203K consultant fee schedule. So all that stuff will go into effect in case numbers issued in November. But those are cool changes.